Hi, I'm Gwen Preston of Resource Maven with some comments on what all this mixed economic data means for gold. These days, whether you're zoomed out or zoomed in, economic data are really mixed. That mix is why investors have been pretty uncertain of late. And the result is that the broad US markets, the US dollar, bonds, and gold have all basically been trading sideways. Now, this mixed data situation is sort of interesting in and of itself, and it turns out, I think, it's pretty positive for gold. Let's just take last week, for example. In fact, just Wednesday itself. On Wednesday, we started out with a very strong ADP jobs report. That strength in the jobs market pushed US markets and the dollar higher, and it punished gold. About an hour later, we had another number. We had a middle-of-the-road number for services PMI. That sort of suspended all of the moves. The dollar and the market stopped moving, and so did gold. Only about an hour after that, we got the minutes of the March meeting of the Federal Reserve, in which the Fed suggested that it was going to start unwinding its massive $4.5 trillion balance sheet sometime soon. That turned the markets down, pushed the dollar down, and lifted gold back up again. That all just happened in the space of one day. If you step back, it's happening on a big picture as well, and this mixed data is creating a really interesting situation. Specifically, it's creating a strange and actually unstable divergence. What we have is soft data, things like consumer confidence, keep rising, whereas hard data like car sales or manufacturing growth in general are falling. It's quite a gap that's developed between those two, historically large gap actually, and it's really quite significant. As one way to show how it manifests, let's take GDP growth. So when analysts forecast or try and calculate what GDP growth is, they can either include that soft data or not. Those right now that are including soft data like consumer confidence, they're predicting that Q1 GDP growth is about 3%. Those who are only including the hard data are coming in at 1%. For a GDP number, that is a huge difference, and it's pretty darn significant. Okay, so what does all of this mixed data and uncertainty mean for gold? Well, I think it means two things. At the end of the day, not two things, at the end of the day, the point is that most of this mixed data can and is being interpreted as bullish for gold. Whether you're thinking that we're going to see economic growth and stronger markets, whether you think we're about to see sliding markets, whether you think the euro is strengthening, whatever you think is happening to the dollar, whether you think interest rates are going up or going down, all of those things can and in fact are being interpreted as bullish for gold. The yellow metal, often in these mixed data scenarios, rises at the end of it all. I think what's happening is, in all of that confusion, in all of that uncertainty, each time enough investors turn to the safe haven of the yellow metal, and that's providing more than enough support for gold to keep gaining, whether now, immediately, or later in the year. And that's what we need. So it's a strange situation with this divergence and all this mixed data, but as it turns out, it's working well for gold.